Hello everyone, let's start with the module 7 laws and regulations related to banking sector. So this particular module is divided into three main categories of concepts. The first is related to the Banking Regulation Act 1949. So here we will understand the importance of this particular act and various provisions related to board of directors, chairman, licensing, dividends, loans, statutory liquidity ratio, cash reserve ratio, all these requirements. Moving on to the second category, which is the role of RBI. So RBI's role related to the monetary functions in India, as well as the banking functions in India, as well as the regulatory functions. So that particular role of RBI will be discussed in the second category. Moving on to the last will be SURFACE 2002. This is the biggest title of the act. So here surfacing means securitization and reconstruction of the financial assets and enforcement of Security Interest Act 2002. So here in this we will understand the meaning of asset reconstruction, the meaning of securitization, formation of asset reconstruction company, registration, cancellation of license, takeover of the management by the asset reconstruction company, and then enforcement of security interest. You don't need to worry about that. This particular module will make you understand the basic terminology related to the banks, related to the asset reconstruction, because without this basic terminology you cannot understand the concept and you will be stuck at the beginning. So, if you get the hang of the terminology and basic meanings, this particular module will be very easy for you to remember and write it down in the examination. And moving on to the weightage point of view, a compulsory question will be asked in the examination. So, previously, last two attempts, it was 3 marks, 3.5 marks, descriptive, and compulsory 1 MCQ will be asked. And before that, like initially, when the new syllabus was introduced, 8 marks, 7 marks was given from this chapter. So, irrespective of the marks, one question will definitely be asked as per the weightage and the history of the past questions. So, let's get started. So, first and the foremost thing we will be discussing about the introduction to the Banking Regulation Act 1949. So here it is a central act, central piece of legislation which was created by the parliament. Now the entry 45 of the union list has given the power to the parliament to frame rules related to the banking. So, to frame rules related to the banking, which act was framed by the parliament? The Banking Regulation Act 1949. So, now this will be applicable. So initially it was applicable only to the banking companies, but later on it has expanded and it is also applicable for corporate banks, other small finance banks, other organizations engaged in banking activities. So yes, for all the activities related to banking, that is accepting of deposits and lending of loans, Banking Regulation Act 1949 will be applicable until and unless special acts are applicable for special kinds of banks. But overall, for banking activities in India, which act is applicable? The Banking Regulation Act 1949. So, it is applicable to banking companies. So, what are banking companies? Banking companies are companies which are engaged in the business of banking. What do you mean by banking? Two things, simple: accepting deposits and lending loans. These two are the main businesses of banks, and that is only called banking. Okay, clear? So, moving on, moving back to the banking company definition. Banking company means a company which is engaged in the business of banking. Clear? So it is of course registered under the Companies Act 2013, and it should get the license from the RBI to operate as a bank. Two requirements. What is that? Registered under the Companies Act 2013 or any previous company law, and it should get the license from where? From the RBI. So that is the definition of a banking company. Not definition, meaning of a banking company. Are we clear? So that is why for banking companies, Banking Regulation Act 1949 is applicable, as well as the relevant company law is also applicable. Previously the company law was Companies Act 1956. Right now, since Companies Act 1956 is replaced by the Companies Act 2013, so Banking Regulation Act 1949 for this, what will complement and together they will be acting as a rule book for the functioning of the banks is the Companies Act 2013. Are we clear with this? So let's have a quick revision of the introduction sentences. So the Banking Regulation Act 1949 is a key central legislation in India enacted under the authority of the entry 45 of the Union list. So it regulates all banking institutions but across the country banking institution, but initially it was applied to only banking companies. Right now it's applicable to all banking institutions. So this act established a robust framework for the supervision and regulation of commercial banking in India, complementing. But that means some of the provisions for banks will be applicable, will be lying under which act? The Companies Act. Clear with this now? So this Banking Regulation Act, this is an act, just a rule book. It's not an authority. So who has the authority to enforce the provisions of the Banking Regulation Act and enforce any penalties and make the rules directives for the functioning of the banks? Reserve Bank of India. So that is why Reserve Bank of India is the regulatory body. Clear? So the act gives the RBI the power to license banks, supervise the appointment of board, management, supervise banking operations in India, and audit, issue directives for public good, for the protection of the investors, sorry, for the protection of the customers of the banks, related to the interest rates, related to the capital ratios, all that, issue directives and banking policy, enforce penalties for non-compliance if bank commits any non-compliances of the act. So enforcing the penalty, who will act as the regulatory body for enforcing and imposing the penalties? The Reserve Bank of India. Are we clear with this? So this is the introduction to the Banking Regulation Act 1949. If I have to simply wind it up, it is the backbone for the commercial banking in India. So it's act like one piece of framework for all the banks, applicable for all the regulations related to the banks. Are we clear with this? Now, moving on to the first concept. So, we know that banking companies engage in which activity primarily? Banking. What's banking? Accepting deposits and lending loans. That's all. But addition to this, other activities can also be performed, or it can engage in other activities that is other than banking. So, what are these activities? We will see few activities which the banks can engage. Are we clear? So, first and the foremost thing, may undertake and execute trusts. So, if there is any property or if there is any fund is nothing but a pool of money. So clear, if there is any property, if there is any fund. So since as individual you may not trust other individuals to have control over the property or control over the fund, so you can appoint a bank as a trustee. What do you mean by a trustee? Bank will have the control, and bank will manage your fund, bank will manage your property, and if you have to pay some amount, that is maybe rent or some interest from that property to a beneficiary, who will pay that? This particular bank. So here bank has the power to act as a trustee. Are we clear? The other activity that it is executing other than those banking activities, nothing but executing trusts. So some rich kids, what they will have, their parents will create a trust fund for them. What do you mean by this trust fund? If they have grown up, they can use it for their educational purposes and for their, for entrepreneurship or for their businesses. They may use this trust fund. Yes or no? Now parents will appoint banks as trustees. So banks will give the money to the beneficiary, who beneficiary is nothing but the child. Are we clear? So I hope you got the example. But if we have to just frame it into a phrase, make, may undertake and execute trust. So a banking company may undertake and execute trust, acting as a trustee for individuals or organizations. Are we clear? Now, moving on to the next activity, may undertake the administration of an estate. What do you mean by an estate? Property, assets, monies, investments which are held by a person. But if that person is dead, all this property will be called as what? Estate. Now, there should be one person, one like a neutral party, who will actually utilize this estate to clear off all the debts, pay to the legal heirs, that may be the children or other, other persons whose name is mentioned in the will which is created by the person who's dead. Yes or no? So who will execute that particular power to administer the estate? Banks. Are we clear? So not banks, you can appoint bank as an administrator. Clear? So may undertake the administration of estates. A banking company may manage estates, acting as administrator for the estate of deceased persons or for the other purposes. Now moving on to the next activity, may establish and support associations of employees welfare. So if banks wants to create any employee pension funds or employee education, employee children education like scholarship programs, or for health insurance purpose, if it wants to create any funds, if it want to create any schemes, yes, it has the power to do that. So a banking company may establish the support in the creation of associations, institutions, funds, etc., for the benefit of its employees. Next, moving on to the next. Of course, banks, for its operation, it needs buildings for branches, ATMs, and other functions. Yes or no? For this purpose, bank may acquire, construct any buildings. So, a banking company may acquire any building or infrastructure necessary for conducting its businesses or other purposes. So, initially, we have seen how many till now? Four. May undertake and execute trust. Next, may undertake the administration of estate. Next, may establish and support associations for employees welfare, and may acquire, construct, and maintain and alter buildings. Clear with this basics. Other duties other than banks, other than banking services, what a bank can do. Clear? Next, moving on to the next is may sell and deal with its property. So whatever the property that it has, it can sell it, or it can build, or it can deal with the property, it can give it as a mortgage, it can dispose of other way. So a banking company may sell, improve, manage, develop, exchange, lease, mortgage, dispose of, otherwise deal with its any of its property. Property means assets of the bank. Clear? Now next, moving on to the next thing is may take over the other business. So banks can engage in merger and amalgamation with the other organizations, but make sure the organizations are also engaged in banking related activities. So a banking company may acquire the whole or the part of businesses of any other person or company, provided the business is related to banking. So specifically for the particular amalgamation and everything, sections are there under the banking regulation, but yes, generally they are allowed to acquire part or full of the business of another entity. So make sure the other entity is also involved in the banking business. So overall, a banking company is engaged in another form of business, provided it is lawful and it is declared by the central government that it is lawful to carry out that business by a bank through a notification. So simple. This particular concept will give us the different forms of businesses a banking company can engage in other than banking services. I hope it's clear. Now, moving on to the next concept. Now, we are here related to the board of directors of the banking company. So, board of directors play a very important role in the banking company, not only in the banking company, any company, they manage its affairs. So, Banking Regulation Act 2000, sorry, 1949 says that if you want to act as a board of director of a bank, you can't be dumb, you need to have specialized knowledge. So that is why the rule says at least 51% of the board of directors of a banking company should have a specialized field of knowledge, maybe in accounting or finance or law, whatever is the specialized field which is notified by RBI. He needs to have that qualification or that particular knowledge or experience. Otherwise he can't act as a director. I'm not talking about the whole board of directors, at least 51%. So every banking company must ensure that at least 51% of the total number of board of directors consists of individuals with specialized knowledge or practical experience in fields such as accountancy, finance, law, etc., or any other area deemed useful by whom? By RBI. Are we clear with this? And bank should have at least two directors specifically related to the concerns of agriculture, financing, as well as the rural economy and small scale industries. So it's nothing but, if there is a bank, the whole board of directors are not concentrated on one specific field of expertise. You need directors who are expertised in the agriculture financing, some in the rural industry, some in the small scale industries. So they know what is the purpose of the banks, and they know how to specifically deal with that particular sector of financing. Clear? So of these directors, at least two must have special knowledge or experience in the agriculture and rural economy and small scale industry, and they may be associated with the small industrial concerns. For that small industrial concern, first the rural concerns, they will be associated to whom? Those specific two directors. Are we clear with this? Now, Moving on to the director's tenure, maximum tenure of any director other than a chairman or a managing director, maximum tenure for all the other directors is 8 years. Are we clear? Now, they should not have conflicting interests. So, the directors must put the interest of their personal interest away from the banking interests. So, they should not be engaged in some insider activities. They should not be engaged in favoritism in the banks. They should have the objective of development of the bank as well as the banking business. Their personal interest should not conflict the interest of their business. Are we clear? So directors must not have any conflict of interest with the connected parties. There is nothing but having independency. Are we clear? Now RBI has the authority, so RBI can remove a director, RBI can reconstitute the whole board, RBI can appoint a director. So that power is given to the RBI by the Banking Regulation Act. So RBI has the authority to order the reconstitution of the board of any bank if necessary, and also the removal of any director if they are not satisfied with the order of RBI. They are like, how RBI can remove a director? So if he is actually concerned with the order of the RBI, he can appeal to the central government. Are we clear? So now there must be no common director. So a director cannot act, a person cannot act as a director in two or more banks at a time. So there cannot be a common director across different banks. So these are the provisions related to the board of directors of the banking company. Now moving on to the specific provisions related to chairman. So of course every banking company will have a chairman who will have the whole authority of the board of directors. Are we clear? So he will act as a chairperson, so conducting board meetings, so have the role, same role which chairperson plays in the company's board of directors, this person also act as a board of director, acts as a chairperson of the board of directors. So simple, he will have the utmost powers like a managing director. So there can be a chairperson or a managing director. Now if that particular person is a part-time chairman, then managing director needs to be appointed. If he is a full-time, managing director need not be appointed. So every banking company must have one of its director appointed as a chairman of the board of directors. So he can be either a whole-time director, a whole-time chairman, or a part-time chairman. If it is whole time, then the whole affairs of the affairs of of that particular bank will be in the hands of that chairman. So the chairman will manage the entire affairs of the banking company, subject of course specific activities and supervision and control will be executed by the whole board of directors, but the overall control and the main person will be the chairperson. Clear? Next, the chairman appointed on the part time basis, then what happens, there will be another person who will have the overall supervisory controls, that is the management will be entrusted to the managing director. Now here comes the tenure, which is important from an examination point of view. The tenure of all the other directors will be a maximum of 8 years, but for the tenure of chairman, I'm using the word interchangeably, both meaning same, chairperson, chairman, both the same. Chairman is gender biased. Now moving on to chairman is gender neutral. That's all clear. So both the chairman and the MD must be appointed with the RBI approval, and the tenure of such approval will be 5 years. So tenure for the chairman or the managing director will be maximum of 5 years. Are we clear with this? Now, if the position of whole-time chairman, there is a whole-time chairman or there is a managing director and the position becomes vacant. Now RBI, if it is of the perception that we need a person in that particular place for the functioning of the bank, so they can appoint an eligible candidate. Who can appoint? Reserve Bank of India can appoint an eligible candidate who will act as a chairman or the managing director. Are we clear? But one thing is, keeping this exceptional situation of vacancy aside, generally only a director can act as a chairman or a director can act as a managing director. Are we clear? But in this exceptional case where the position is vacant and RBI is appointing an eligible person to fill that vacancy, so that that person who is actually being appointed by RBI may or may not be a director. But if he has been given the role and he has been appointed by RBI, he will be considered as a director. Are we clear? So, if the position of whole time chairman or managing director is vacant, the Reserve Bank of India has the power to appoint an eligible person to the role. So, if the appointee is not already a director, then they will be deemed to be a director for as long as they hold the position, and this particular position will also be held by that particular person for a period of 5 years. Are we clear? So that's all related to the provisions of the board of directors and the chairperson of the particular banking company. Yes, now let's move on to the next concept, which is related to the minimum capital requirements and related to capital adequacy ratios. This is section 11 and section 12 of the Banking Regulation Act. Now, first condition here is, let's say that of course every company, since it's a banking company, it will have authorized capital. Now the condition is, whatever the subscribed capital is there, the particular shareholders that they subscribe, re- keep aside payment, subscribe. Are we clear? So the subscribed capital should be at least equal to how much? 50% of the authorized capital. So subscribed capital is equal to or more than 50% of the authorized capital. Next condition, paid up capital, the actual amount which is paid by the shareholders, paid up capital should be at least, that is equal to or more than 50% of the subscribed capital. These two requirements must be met. Let's say authorized capital is increased. Now, of course, to meet this 50%, it can't be met immediately. So, what is the time period that is allotted here under the Banking Regulation Act to meet that particular limit is maximum 2 years, or else whatever the RBI guidelines specify. So, this is the first related condition related to the capital limit. So, subscribed capital must be at least 50% of the authorized capital, and paid up capital must be at least 50% of the subscribed capital. Now, when capital is increased, the ratio can be maintained within a maximum period of 2 years or as the RBI guidelines specify. Next, the capital form, like which forms of capital instruments can be issued by a bank: equity shares as well as preference shares. Now, beyond these statutory requirements of 50% of authorized capital or 50% of subscribed capital, what is more important right now for the banks to achieve is capital adequacy ratios. I repeat again, CAR, capital adequacy ratios. Now, what do you mean by capital here? Whatever the equity share capital, preference share capital, share premium account, as well as free reserves, and all that comes under these particular capital. Yes or no? So, now, so whatever the capital is there, that should be sufficient enough to meet our losses. What do you mean by losses for banks? Now, banks, one of the primary activities other than accepting deposits is lending advances. Yes or no? Now, I have lent as a bank, I have lent a loan to some parties. Now, if they have made a default in repaying the loan, what happens? I am suffering a loss. Yes or no? Now, if you imagine a balance sheet, now the left side we have liabilities, the right side we have assets. Now, let's say one of the asset, which is the loan which I've lent to a party, yes or no, that is recoverable, it's a receivable. I have calculated that down in the asset section. Now, that particular party is not repaying back. So, is it a loss asset? Answer is yes. So, there is a loss that, let's say, imagine 100 crores, sorry, 10 crores amount is not recoverable. There's a loss of 10 crores here. Now the asset side value has been decreased by 10 crores. Now you have to adjust it accordingly in the liability side. So from where will you adjust? The capital, equity capital, preference capital, free reserve, share premium, whatever is there, this particular capital will be reduced. That means the capital here in the liability section will absorb if there is any loss in the asset section. So, are we clear? So, in order to avoid this situation, or if this situation happens, we need enough capital. Yes or no? If this situation, there are a lot of parties who are defaulting the loans. Now, if this situation occurs, you need enough capital in the liability section to meet these losses, to absorb these losses. So, that is why these particular RBI guidelines as well as the international standards, that is Basel III recommendations, specify that in order to avoid this loss, you need to have adequate capital. That is what is called capital adequacy ratios. Are we clear? So, here let's read the sentence. The shares of the banking company can either be equity shares or else the preference shares. However, beyond statutory capital requirements like these, banks now focus on capital adequacy ratios, especially to manage non performing assets. What are non performing assets? Asset is a loan for a bank. I've lent a loan to a borrower. If he pays me back, it's an asset receivable performing. Wonderful. But if he's not paying me back, it's not performing. My asset is not recoverable. It's a non performing asset. Are we clear? So in the non-performing assets in detail, we will be looking under the Surface 2002. For now, to manage any losses which are occurring due to the non-performing assets, you need to have enough capital. That is the purpose of capital adequacy ratios. Are we clear? Now, of course, the international standards that are strict regulations and strict percentages of capital needs to be followed by banks. Why? Because banks are involved in very sensitive businesses related to money. So these strict regulations are to be followed. And these are not just the guidelines which are released by RBI, these are international standards which are called the Basel III recommendations. So the Basel Committee guidelines, particularly the Basel III recommendations, are relevant to Indian banks. Now, what are these guidelines for? If there are any risks, if there are any losses, how to overcome them? How should your position be? How strong you have to be in terms of your capital or in terms of your risks or in terms of your policies, so that whatever the loss that you incur in future, you are able to manage it. So that particular recommendations must be strictly followed by Indian banks. So let's see what are the three major pillars which are actually prescribed in the Basel III recommendations. So let's look into the three major pillars. First and the foremost thing, you maintain enough capital. So minimum capital requirement based on, now comes a new terminology, risk weighted assets. What do you mean by risk weighted assets? Listen carefully, I'll explain it very quickly. Now, asset 1, loan you have lent to a party, let's say a public sector unit or a government or government body or whatever the loan that you've lent. You are 100% sure that you will receive back the money. You are 100% sure that the risk is involved is zero. If risk involved is zero, what will be the asset value? 100% asset is being recovered, so asset percentage, asset amount will be 100%. Let's say now I have lent a loan to a person, so there is a 20% risk that the person might not pay me back. So if 20% risk is there, how much asset is actually receivable if there is a loss? 80%. So the amount into 80% will be the risk adjusted asset value. Are we clear? So simple. Based on the risk percentage involved, you will calculate the actual amount of asset value you can recover even in risky situation. That is risk weighted assets. You will calculate the actual asset value even if there is a loss. So minimum capital requirements based on the risk weighted assets to cover the risks that you have to maintain. That is one of the pillar which is recommended by, which is given in the Basel III recommendations. Next, supervisory review process to manage any peripheral risks. What do you mean by peripheral risk? Any economic changes, or due to any interest rate changes, or due to any defaults, or any peripheral risk like it's not the direct risk related to the payment of the loan, it is the market changes or economy changes or financial crisis. So due to that, if there are any risks, you have to ensure you're still overcoming that risk by conducting a supervisory review of banking operations. So are the banks able to meet any capital requirements? What are the losses the bank is being incurred? So making sure the operations are properly reviewed, so that even if there are any risks in the market, you're still able to recover from those risks. So supervisory review process to manage any peripheral risks. Next, market discipline to increase transparency by requiring disclosures. So if the banks is in tough situation, or if the bank does not have enough capital, or if the bank has a lot of non-performing assets, it is better to disclose it transparently rather than hiding the fact, and then you are indirectly harming the depositors who is having a trust in the bank. Yes or no? So that transparent disclosure is one of the pillars. So three pillars: one is to maintain minimum capital, supervisory review any other risks which are there, you are able to manage that, and the third will be your market discipline to increase transparency. So these are the three pillars of capital structure which has to be maintained by the, which has to be followed by the bank. So what are these called? Basel 3 recommendations. Are we clear? Now, So banks must maintain capital quality and buffers along with the common equity tier 1 and tier 2 capital. Okay, now comes another new terminology. I know there are a lot of new terminologies, but please pay attention. You can understand easily. So, two different capitals: common equity tier 1 and common equity tier 2. So tier 1 capital and tier 2 capital. I've already told you the liability and asset situation. You imagine if there is a loss, first loss will be absorbed by which capital? Tier 1 capital. That means if there is any loss in the asset section, which particular that loss will be adjusted with which amount of capital? First tier 1. What is actually there in the tier 1 capital? Your equity capital, as well as your reserves, as well as your share premium account, and any reserves that you maintain. Now moving on to the tier 2 capital. Tier 2 capital, you will have subordinate debt. Subordinate debt means the obligations at the end. After I complete the after I complete the payment of all the liabilities, I will pay you back. That is subordinate debt. It's a last priority. That is why you will keep it in under the tier 2 capital. And tier 2 capital will have all these revaluation reserves, and then your preference shares where you have to still pay those. These will be there in the tier 2 capital. Are we clear? So now banks must maintain capital quality. The capital tier 1 capital and tier 1 capital, tier 2 capital has to be maintained, and you have to maintain a buffer. What do you mean by buffer? Safety capital. If there are any additional losses, you need to have safety capital. So that is only called a buffer. Are we clear? Now, actually, how much should be maintained? How much capital adequacy ratio should be maintained? Capital adequacy ratio as per the particular Basel III norms as 9% of the risk weighted assets. Are we clear? So how do you calculate the formula? It's very simple. Bank's capital, common um tier 1 capital plus tier 2 capital divided by risk weighted assets. That is actually what the percentage of the capital adequacy ratio. So by January 1st, 2019, Indian banks must comply with Basel III norms, ensuring a minimum total capital of 9% of the risk weighted assets. I hope I'm clear with this. Now let me just give you a quick overview so that you will not be confused. Yes, let me just write down the formula for you. That will be easy for you. So what is capital adequacy ratio? So tier 1 capital plus tier 2 capital, that is the whole capital, divided by risk weighted assets into 100% into 100 to calculate the actual percentage. So how much should be the actual percentage as per January 2019? It should be 9%. Are we clear? As per the Basel III norms. So this is the actual formula for capital adequacy ratio. How much capital should be maintained? Are we clear? So that's all. If you still feel a little difficulty, I'm telling you, just go back to the video, listen carefully, you will understand. Are we clear? So now moving on to the next section, 15, the most asked particular provision from an MCQ point of view. It's like most repeated: payment of dividends by banks. Can banks pay dividends? Answer is yes. But the condition here is all the capitalized expenses must be written off. What do you mean by capitalized expenses? Your preliminary expenses, your brokerage expenses, all these are capitalized expenses that you incur on issue of shares, that you incur during incorporation. So all these particular expenses must be written off, and then you can pay the dividend. So that is what is the particular section 15 says: restriction on payment of dividends. So limiting the payment of dividends, so prohibits every banking company from paying any dividends on its shares unless it has completely writes off. So it's completely written off the capitalized expenses. Examples they will ask you in the they might ask you from MCQ point of view: preliminary expenses, brokerage, commission on issue of shares, etc. All these fictitious asset expenses will be there, no? So all that should be written off. Then only you can pay the dividend. Now, moving on to the next cases. Without writing of these following categories, so these three, without writing of these three particular amounts, you can still pay dividend. So what are these three categories? First will be the depreciation. Banks make investments, in government approved securities. What do you mean by approved securities? These government securities, treasury bills, where the risk involved is very less. So banks are investing in these particular approved securities. Now if that security value decreases, depreciation is there. If you are not accounting the depreciation, are we clear? Then you can actually pay the dividend. So the depreciation in value of investments in approved security which has not actually been capitalized, you are not accounting for the depreciation loss, you are not capitalizing the depreciation loss, then you can actually pay the dividends. Are we clear? Next, depreciation in value of investment, these are other than approved securities. These are risky securities. Are we clear? You make investment in risky securities, you should not adjust, then pay the dividend. Clear? Now moving on to the risky security, if there is a depreciation, what has to be done is two conditions should be met. First is you have to make a provision for depreciation of these investments, and the next, it should be approved by the company's auditor, both these cases. And then moving on to the next case, whatever the bad debts are there, a proper provision should be made, then this particular dividend may be declared. So whatever the situation is, the capitalized expenses are written off, and these particular cases also, if you want to declare dividend at any point of time, you need to get the approval of RBI. Clear with this? So however, a banking company may pay dividend without writing of the following. What are these amounts? Let's revise quickly. The depreciation in the value of investments. Which value of investments? Approved securities which has not actually been capitalized. You have not capitalized, you have not capitalized, you don't need to write off. Are we clear? So you can pay the dividend. Next, depreciation in value of investments in shares, debentures, bonds other than approved security, where depreciation is there, but adequately what you have done, you have created a provision to account for the depreciation. Well and good, and it has been approved by the company's auditor related to that adjustment. Clear? And the next, bad debts, where the provision has been made and approved by the auditor. So even if these bad debts depreciation is not written off, you can still declare dividend. And the next, most important, all dividend payments require the specific approval from Reserve Bank of India. All the dividend require, all the dividend payments. So this is very important from an MCQ point of view. Now moving on to section 17, 18 and 19. These are related to the reserve funds. These are related to the reserve funds to be maintained by the banks. Let's get started. So of course banks make profits. Now how much of the percentage should be transferred to the reserves by the banks every year? Generally for all the banks, the amount which is the percentage which is fixed is 20%. So generally for all the banks, how much should be transferred to the reserve fund out of the net profits? 20%. So banking companies incorporated in India must transfer at least 20% of their annual profit, which is their net profit, to the reserve fund. Are we clear? Now, in one case, if central government gives approval based on the recommendation of the RBI, then you don't need to transfer 20%. That too, when the recommendation of RBI will be provided, if the amount in your reserve fund plus your share premium is equal to or more than paid up share capital. Once again, let me just quickly revise it with you. The reserve fund, which is nothing but your free reserves plus your share premium, is more than or equal to your paid up share capital value. If this condition is met, then RBI is providing recommendation to the central government, then central government may provide exemption to that bank not to transfer the 20% or that particular relevant amount. Are we clear? That's all. So, banking companies incorporated in India must transfer at least 20% of their annual profit to the reserve fund unless the reserve fund with share premium equals or exceeds the capital, company's paid up capital. That is, this requirement can be waived by the central government based on the RBI recommendation. When it will be waived, this condition should be met. RBI should give a recommendation, central government will waive. That's all. Clear? So, just let me erase this. It will be clear for you. So, if let's say the reserve fund is created, you want the reserve fund for adjustment of any losses or for the purpose of expansion, or you're utilizing that for business purposes, you're utilizing the reserve fund. So, appropriation from the reserve fund, you need to report it to the RBI that this much amount I have utilized. For what purpose you've utilized within the 21 days of taking that money from the reserve fund, you have to inform to the RBI. So, any appropriation, that is withdrawal from the reserves, must be reported to the RBI within 21 days with reasons for what purpose you've withdrawn from the reserves, and specifically the percentage for the scheduled commercial banks, including foreign banks operating in India. For these two kinds of banks, the percentage of amount to be transferred is not 20%, it is 25%. Clear? So additionally, all the scheduled commercial banks, including foreign banks in India, must transfer a minimum of how much? 25% of the net profit to the reserve fund. That's all related to the transfer of reserve. Now comes again the most important percentage from an examination point of view, that to MCQ point of view, which is cash reserve ratio. How much of the amount should be maintained in the form of cash with the bank? Every day the bank should maintain a minimum of 4% of its demand and time liabilities. What do you mean by demand liability? Deposits, depositors will come, demand the bank, immediately that deposit should be repaid back. Demand liability. What is time liability? There will be a duration which is set, after which the deposit should be repaid back. Are we clear? So demand liabilities plus time liabilities, whatever the total liabilities is there, into 4%, that should be the minimum amount. Every day it should be maintained by the by the bank in the form of cash. Clear? So non this percentage is specifically for non-scheduled banks. Non-scheduled banks are required to maintain a cash reserve in India, either with themselves or with the current accounts in the bank. It maintained with the bank or with the RBI, so or state bank or other notified banks. The reserve should be equivalent to how much? At least 4%. Clear? So of what percentage we are talking about? Total time plus demand liabilities, and must be maintained on daily basis. Every day you need to have 4%. Clear? Non-scheduled banks, so their compliance that we are maintaining every day this much amount of cash reserve ratio. So when will they intimate to the RBI? By the end, by the end of 20th. So by 20th day of every month, by 20th day, on the 20th day is the last day for you to report it to the RBI that I have complied with the requirement of cash reserve ratio maintenance every day. Are we clear with this? Now, moving on to the section 19. This is related to formation of subsidiaries. Can banks acquire controlling interest of another company? That is nothing but form subsidiaries. Answer is yes. But the particular company should also be involved for the purpose of banking activities, or else that particular subsidiary should also be involved in what activities? We have seen section executing trusts, properties, acquiring buildings, employees welfare. These activities you have seen, which is other than banking activities, which is permitted by the RBI, yes or no? So those activities, if the subsidiary company is formed, yes, it is allowed. For banking activities, it is formed, yes, it is allowed. So imposes restrictions on banking companies regarding the formation of subsidiary companies and the holding of shares in the other companies. Now, cat banks are not permitted, of course they are not permitted, but listen carefully. Banking companies are not permitted to acquire controlling interest in non-banking companies or engage in activities outside the banking sector through such acquisitions. However, banking companies can form subsidiaries for the purpose incidental to banking with the prior written approval of RBI. So, any activities which are incidental, so that is related to banking activities, yes, you can form subsidiaries for. Of course, you need to get the approval of RBI. So this is section 17, 18, 19. 17 talks about the amount to be transferred from the net profit to the reserve fund every year. 20% generally for scheduled commercial banks, and foreign banks in India it is 25%. Clear with this? Now, cash reserve ratio 4% of the total time and demand liabilities. And then moving on to the subsidiary formation, they can form subsidiaries for incidental activities to banking. That's all. Now, moving on to the restrictions on loans and advances. The loans amount, whatever the amount that you lent as a loan, the amount that you take from deposits, yes or no, it's sensitive public money. So that is why when you are lending money, which is public money, you have to be very careful, and you have to ensure the other party is the risk is assessed, the credit score is assessed, the ability to repay back, all these is assessed. All these are properly assessed before you give the loan to that particular party. So of course, for this purposes, RBI will actually lay down restrictions of what purposes you can lend loan, how much should be the interest rate, and all these particular maximum amount restrictions will be laid down by the RBI. RBI has that power to lay down the restrictions on purposes of lending loan. Now, other than that, a banking company cannot grant loan to its directors or to the parties and firms in which the director is interested in. Are we clear? So, first, section 20, banking companies cannot grant loans to any of its directors or any firm where a director is interested. That means a firm in which director is a partner, director is a member, or a director has made capital contribution for that firm. Also, bank cannot grant loan. Next, individuals for whom director is standing as a guarantor. Direct that third party individual has taken a loan from other bank, clear, but director is acting as what, guarantor. Are we clear? So can the bank provide for provide a loan to that third party for which the guarantee is a director? Answer is no. Clear. Next, banking company are also barred from providing loans and advances secured by their own shares. This is very, very silly concept, but very logical. So I am taking a loan from whom? From the bank. Now, what am I giving as a security? Bank's own shares. So if I default, sell your own shares. That is completely not allowed. Are we clear? So banking companies are also barred from providing loans and advances secured by their own shares. Clear with this? Next, RBI has the authority to regulate advances by banks in the interest of public. So to ensure the public is protected, the public money is protected. You're not just giving money to corporate houses, unlimited amounts of money with lower interest rate. So to avoid these situations of favoritism or you know uh, illogical or else unreasonable amount of loans to be given to third parties, to ensure that RBI will put restrictions of how much amount you can lend to a person, for what purpose you can lend, and what will be the interest rate which is charged. RBI has that power. Clear? So for on what particular features it can put restrictions, purpose. So let's say one party will come, he's a corporate house, let's say he's a high net worth individual, he's asking loan from bank for going for casinos or for bettings or for some horse racing or something. Can the bank provide loans for these not illegal, actually improper purposes? Answer is no. RBI will put restrictions for what purpose you can grant loan. So purpose restrictions, guidelines on what purposes loans may or may not be granted. For that, RBI will put restrictions. Next, margin requirements. What do you mean by margin requirements? Bank has lent a loan of, let's say, 10 lakhs. Now, how much security I will expect? Generally, how much security value I am expecting to receive? 10 lakhs, yes or no? But bank will put margin. I have, as a bank is lending 10 lakhs. Security value is 10 lakhs, will not be accepted. A minimum margin should be maintained. Security value should be at least 13 lakhs, 12 lakhs. That margin should be maintained. Buffer. Clear? So, specifications for margin to be maintained for secured advances. Next, interest rates, how much interest rate should be charged. So regulations on the rates of interest charged for the advances, other financial accommodations, and commissions on guarantees. For all these requirements, RBI has the power to place restrictions and impose any regulations. Clear? So determination of the maximum amount, how much it can be, how much it can lend. Financial accommodations a bank may issue to a single party based on the bank's paid up capital reserves and deposits. To a single corporate house, you can't give unlimited access to the amount. There should be a maximum amount you can actually lent in the form of loan. That particular restrictions will also be placed by banks. Are we clear? So this is section 20 and section 21. You don't need to remember section numbers, it's really hard. Make sure you remember the section numbers of the Companies Act, that's more than enough. Are we clear? So moving on to the next case is related to the licensing of bank, which is again section 22. Yes. Now, first and the foremost thing, a company is registered. If a company has to operate as a bank or company has to conduct banking activities, it needs to get the license of RBI. It needs to get the license from RBI. Are we clear? So that is the first and the foremost requirement to act as a bank. So let's see. No banking company can begin or continue banking operations in India without a license from the RBI. That is the particular condition which is specified in section 22. Clear? Now there will be non-banking financial companies, or there will be some financial corporations or some companies which actually wants to start activities like banking. You're already established, you're already incorporated, but now you want to start banking operations. So you need to get the license, you need to obtain the license from the bank. So when the bank will give the license for you? So RBI, before it grants license, it will check few things. It will inspect your capability to act as a bank. Clear? So what are the first condition which will be inspected by the bank, by the RBA? First, right now company is there, company has some deposits. Now if the company is able to meet its current liabilities, current deposits and future claims, whatever is there, company has enough fund to meet those liabilities or not, that will be inspected by the RBA. Next, companies banking operation, they are not negatively affecting the interest. That means they are not actually engaged in these particular activities to defraud the depositors, negatively affecting. So taking money, paying lesser interest rate, or paying let's say defrauding the creditors, defrauding the depositors, these particular activities company is not engaged in, so not negatively affecting or affecting the public interest. So that particular thing will be inspection inspected. Next, conducting banking activities that will not actually cause any uh, you know market deterioration, or you can just call like a harm to the Indian banks. Clear? So conducting banking activities will be in public interest, and that the company's home country does not discriminate against the Indian banking companies. The company must also comply with the relevant provisions of the banking regulation, specifically for foreign banks. Are we clear? So foreign banks also will be getting license to operate as banks in India, but make sure they're not causing anything which is actually against the Indian banking companies, and then they are also following the Banking Regulation Act. So these are the pre-licensing conditions. Now moving on to the license cancellation. In two situations, the RBI will cancel the license. What is the first thing? You have the license to do what? Banking operations. If you are not doing banking operations, RBI will cancel the license. Next, RBI will issue directions. If the directions are failed to comply, you follow the directions. You don't follow the directions, the RBI license will be revoked. So RBI can cancel a banking company's license if the company ceases banking operations in India and the company fails to comply with any imposed conditions. So if RBI cancels the license and the bank genuinely feels that there is no fault from the bank's behalf, simple, you can appeal to the central government within 30 days of the RBI's decision. Then central government will give a final decision. So, a banking company agreed by the RBI's decision can appeal to the central government within 30 days, and the central government decision will be final. This is related to licensing of banks. Clear? So, section 22 specifies that if you want to operate as a banking company, you need to get the license from the RBI. RBI will inspect few things before it grants license. One of the conditions over here is to ensure it meets current and future depositors claim in full, and the next, not negatively impacting the interest of the depositors, and it is not discriminating the Indian banking business. Are we clear? Next, when it will cancel the license here, ceases to that you stop business operations, that is banking operations in India. Next, fails to comply with any imposed conditions, you can appeal that to the central government within 30 days. Are we clear? With this, we have completed the major sections. These particular sections are actually minute from an MCQ point of view. They are important, but from a descriptive point of view, there are very small sections. So with just in the next 15 to 20 minutes, we'll complete provisions related to banking regulations. Then we'll move on to the role of RBI. So let's start with the concept. Yes. So the first is related to the opening of a branch. So, if a particular bank wants to open a new establishment or a branch, it needs the approval of RBI. But in two cases, the approval of RBI is not required. If you're opening the branch in the same city, village, town of the existing branch or existing establishment, the RBI's permission is not required. Or if you're opening a temporary establishment for a period of 1 month to, promote your business in an exhibition or a mela, so that is also permitted without any approval of the RBI. So let's look into the section 23. No banking company can open a new place of business in India or abroad, nor can it change the location of an existing place of business without prior RBI permission. But in these two cases, permission is not needed. What is that? Opening a branch in the same city, town, or village. Clear. Next, establishing a temporary place of business for up to 1 month in a city where the bank already operates, particularly for events like exhibitions or fairs. In these two cases, RBS permission is not required. For any other case, if you're opening a new branch in a city where it is not related in the same city, or a temporary establishment where you do not have the business in that city, you need to get the approval of RBI. Are we clear with this? Now, moving on to section 24, statutory liquidity ratio. So, what do you mean by statutory liquidity ratio? The amount of liquid assets out of the total demand and time liabilities that has to be maintained by the bank. Currently, the SLR ratio in 2025 is 18%, but as per your MCQ in the ICMAI, it's 25%. So, if the option has 25%, choose 25%. Clear with this? Now, what do you mean? So, when you have to achieve that ratio? For that, I have to explain you one concept. So, patiently listen to me, you will understand quickly. So, first, let's understand the meaning of the word fortnight. What is fortnight? As per the RBI's terminology, fortnight is a 14 days period starting from Saturday to the next Friday. Saturday to the next Friday, not that Friday. 14 days. That means 2 weeks period it is. Are we clear? This is a fortnight. Are we clear? Now, let's assume I'm not actually going onto the calendar to find out what's a Saturday and then what's the next Friday. Let's assume. Okay? Clear? Now, 3rd February is your Saturday. And then moving on to the Friday, let me just be clear why, because it's again a little too confusing. Yes, let's take an example. So the current fortnight which the bank is in, let's assume it's 8th February to 25th February, Saturday to the following Friday. Now, what will be the preceding fortnight? Preceding fortnight. That means this will be Saturday, and the next preceding fortnight will be the before Friday to the next following Saturday. Clear? So don't just be confused, just listen carefully. You will understand. So the preceding fortnight will be, if I calculate the correct date and which I have calculated previously itself, it will be 25th Jan, assuming 31 days in the January month, to 7th February. Clear? Then, if this is the preceding fortnight, what will be the second preceding fortnight? This will be again the before day. What is it? It's nothing but 11th Jan to 24th Jan. Just to make sure and try to avoid any time wastage, I have framed the example before itself. So to avoid the confusion. Now, what does RBI specify is, during this particular current fortnight period, the whole 14 days, your liquid assets percentage should be at least 18 percentage of what amount, at least 18 percentage of what amount, the last Friday of the second preceding. What is the last Friday of the second preceding fortnight? Fortnight starts with Saturday, ends with the Friday. Yes or no? The second preceding fortnight 14-day period, the last Friday is 24th Jan. So on 24th Jan, what will be your total? what will be your total time plus demand liabilities? Out of this, calculate 18 percentage. That amount of liquid assets you have to maintain every day in this particular fortnight period. This long explanation, no one will ask you to calculate. They will just ask you to mention the percentage, so you don't need to worry about that. Are we clear? So let's get started. So every banking company shall maintain in India liquid assets. What do you mean by liquid assets? Assets in the form of cash, assets in the form of gold, assets in the form of unencumbered approved securities. Approved securities are these government securities, treasury bills, which are approved securities. These securities are unencumbered. What do you mean by unencumbered? You have not pledged them, you have not given them as collateral, you have not given them as securities. Clear? So that will be equal to what? Liquid assets. Liquid, what the meaning of liquid is, you can easily convert them into cash. That is the purpose of liquid. That is the meaning of liquid assets. So how much liquid assets? So amount in the form of gold, cash, unencumbered approved securities, how much it should be? At least 18% as per the current, but 25% as per the MCQ. 25% of what amount? Total time and demand liabilities. Clear? So let's revise the sentence once again. Every banking company shall maintain in India in liquid assets for an amount not less than, that means minimum amount percentage not exceeding 40%. That means RBI can set a limit up to 40%. What is the current limit which is set by RBI? 18%. Clear? So of their total time and demand liabilities, when time and demand liabilities on the last Friday of the second, this is preceding not proceeding, you can correct, second preceding fortnight as notified by the RBI. Are we clear? So it should be at least 18 percentage of the total time and demand liabilities as on the last Friday of the second preceding fortnight. Clear with this? So this is the meaning of statutory liquidity ratio. So liquid assets include cash, gold, unencumbered approved securities, etc. Now all these particular assets, their value should, maximum value that can be considered, but for purpose of calculation is the current market price. So the assets are to be valued at a price not exceeding, that is maximum will be their current market price. So current statutory liquidity ratio notified by RBI is 18 percentage, but as per the ICMA study material MCQ it is 25 percentage. Clear? So this is the meaning. So from this, what you have to take into your brain, SLR right now is 18%. As per the ICMA MCQ is 25%. What is the full form as SLR? Statutory liquidity ratio. What are liquid assets? Cash, gold, unencumbered approved securities or any security which is notified by RBI. What's fortnight? 14 days period from Saturday to the next Friday, following Friday. Clear? So now moving on to the percentage of assets, not just liquid assets, the total assets. How much should be the value of total assets? It should be at least 75% of the total time and demand liabilities. Clear? So banking companies are required to maintain assets equivalent to at least 75% of their demand and time liabilities. What date? At the close of the business of the last Friday of every quarter. Last Friday of the every quarter of the particular banking of the particular year. So you have to maintain how much of the assets on that Friday. Time and demand liabilities you calculate, your assets should be at least 75%. That's all. Now moving on to the returns. Now let's say there is an account. The account is not operated, there is no transaction in the account, there is no deposit, there is no withdrawal, there is no transaction in that business. That is an unoperated account for 10 years. If it is unoperated, you have to report it to the RBI. Are we clear? So let's say that is a fixed deposit for 10 years. Of course, fixed deposit, no transaction will be there, yes or no? If it is 10 years fixed deposit, now that 10 years of unoperatedness from when you have to calculate after the expiry of fixed deposit. Clear with this? Simple. So every banking company must submit a return to the RBI detailing the unoperated accounts in India for a period of 10 years. So the return should be submitted when within 30 days of the end of each calendar year. End of each calendar year, 30 days, you just give them a list of all the unoperated accounts that is not touched for 10 years. Give them that. First of all, for fixed deposit, for fixed deposit, whatever the period it is, 5 years, 10 years, 20 years, the fixed deposit amount is not operated. So the 10 years unoperatedness condition will be applicable from when? After the expiry of the fixed deposit. Clear? So for fixed deposit, the 10-year period starts from the expiry of the date of deposit. So this normal banks will report it to the RBI. Let's say if it is a regional rural bank, it will report to the national bank. What is it? National Bank for Agriculture and Rural Development. This is related to unoperated accounts for 10 years. When you will report? After within 30 days from the date of end of each calendar year. Now moving on to submission of returns in the forms. This is specifically related to the amount of assets and liabilities. Now this you have to make a small correction. Strike this sentence off and mention this sentence. Write down this or take a screenshot of whatever it is. Every banking company shall, before the close of month, before the month closes, which month? Succeeding month. So for this month, let's say for the month of July, for the month of July, the last Friday. So the last Friday, let's say it is falling under 28th July. So 28th July, what are the assets and liabilities amount I have to send a report to RBI? What is the time limit to send a report? The last date of the next month, that is last date of the August. Clear? So every banking company shall, before the close of the month succeeding, before the close of succeeding month, that is the time limit, that to which it relates, submit to the RBI written in the prescribed form a manner showing its assets and liabilities. The value of assets and liabilities on which date? Last Friday of every month. So, for the value of assets and liabilities of the last Friday of this month, what is the time limit to submit the report? The end of the succeeding month. Are we clear? This is the provision related to the submission of report. At any point of time, if RBI wants to check the assets and liabilities of a bank, it can issue directions. So the RBI may require additional information about the banking company's operations, financial affairs whenever it deems necessary. It can ask and it can seek the reports. So it can be related to the investments which are made by the bank, or classifications of advances, different types of advances lent to different sectors. So all that particular information can be sought by the particular RBI by issuing an order. That's all. Now, moving on to the audit. So, of course, auditors will be appointed by the banking companies to audit the annual accounts, and that should be appointed with the approval of the RBI. So, banking companies must prepare their annual accounts according to the prescribed formats, and these accounts must be audited. So, RBI has the authority to inspect any banking company and its records to ensure the compliance with the regulations. So, of course, RBI will have the authority to inspect any accounts of the banking company. Are we clear? So that's all. Now, moving on to the next case is, if let's say the bank is in a critical situation related to a lot of non-performing assets, a lot of frauds, unable to meet the liquidity ratios, or unable to meet the liabilities, that is payment towards the depository. So it's in a very bad situation. So that means the banking situation is affecting the public interest or interest of the depositors. Then RBI can issue additional directions, can issue warnings, can prohibit few activities of the banks. Clear? So RBI can issue warnings or prohibitions to banking companies regarding specific operation if it believes it is necessary for the public interest, or necessary to prevent any conduct that may be detrimental to the depositors' interest of the bank's management. Then in that case, if directions are issued by RBI, banking company should comply with those directions. Are we clear with this? The last, not last, three more provisions left related to the banking regulation. So let's get started. This is related to the powers of RBI. Now, powers of RBI, related to the specifically stressed assets. Now let's move on to that. So first and the foremost thing, when any stressed assets are there, what do you mean by stressed assets? Non-performing assets. So recovery of the non-performing assets, enforcement of security assets, enforcement of security interest, all that we will be looking into the provisions of SARFAESI, for that particular recovery from the stressed assets, RBI will give directions that has to be followed by the banking company. So RBI has the authority to direct the banks on how to resolve the stressed assets. What do you mean by stressed assets? Loans which bank is unable to recover. Clear. And can establish authorities or committees to assist with the particular process. This is related to section 35 AB. Clear. Now for the appointment, removal, or reconstitution of the board, or for the appointment and removal of the managing directors, for all that you need the prior approval of RBI. That one we've already seen before. So banks must obtain the prior approval from the RBI for appointing, reappointing, and removing the managing director, chairman, or directors, as well as any amendments that you make as a banking company to the memorandum of association, articles of association. For all these cases, you need the approval of RBI. Are we clear now? Removal of managers. RBI has the power to appoint additional directors and remove the directors in the banking company. So RBI can remove managerial personnels and other officials from their position and has the power to appoint additional directors as necessary. Are we clear? So if let's say banking operations are actually harming the public interest, then RBI can take actions against the bank and issue directions. That one we've already seen before. If the RBI or the central government believes a bank is operating in a manner harmful to the depositors of the public interest, they can suspend the bank's board of directors. The central government can also acquire the bank's operations under certain circumstances. So they can suspend the board, can acquire the banking operation, merge with another bank. All these directions will be issued by the RBI. Are we clear? Next, moving on to the suspension of banking business. So let's say bank believes that it is unable to operate in this current situation and it needs moratorium. What do you mean by moratorium? Temporarily, all the legal claims against bank depositors will file legal action. No, why are you not paying me back? So all these legal actions and everything will be temporarily paused for around 6 months. Are we clear? Now, when this particular moratorium will be issued? When RBI believes that if you take a gap of 6 months, you will be able to recover, then that particular temporary suspension of banking operations will be ordered. So, a banking company faces temporary inability to meet its obligations can apply to whom? To the High Court. Bank will go to the High Court, specify the details, positions, and everything, and seeks any temporary suspension. Clear. But which halts all the litigants. Halts means stops all the legal actions against it for 6 months. Moratorium means all legal actions like, you know, filing a suit, execution of the order of the court, all these will be temporarily paused for 6 months. That too, if it is ordered by High Court. But when High Court will order, if application must include a report from RBI confirming that the bank can meet its debts if moratorium is granted. Moratorium is granted. That 6 months period moratorium is granted, you will be able to recover from that position. That should be believed by whom? RBI. Then that RBI's report will be attached and it will be applied to the High Court, and High Court will grant the moratorium. Are we clear? So without this RBI report, the bank cannot receive a moratorium. So these are the additional powers of the RBI. So if there are any stressed assets, how to resolve from these stressed assets, RBI will give directions. RBI approval is required for what? Appointment, reappointment of managing director, as well as uh, you know chairman and other directors, and as well as the amendment of MOA, AOA. For that you need the RBI's approval. RBI has the power to remove any managerial person or appoint additional directors. And RBI, if it is believing that the interests of the banks are harmful for the depositors, it can suspend the bank's business and suspend the whole board of directors, as well as acquire the business. And the next is the provision related to bank applying for temporary suspension of the activities, like the 6 months moratorium period. Are we clear? So with this, we have completed the powers of the bank. Now moving on to the next question, important from an examination point of view: winding up of the banking company. So in these particular cases, banking companies, RBI will order the banking companies to be wound up. Clear? So let's see. RBI can apply for the winding up of the banking company under the following conditions. The first, the foremost, whatever the minimum capital requirements that we have seen related to subscribed capital, related to paid up share capital, if it is unable to meet that particular subscribed capital requirements, then RBI can apply for winding up. So if if the bank does not comply with the minimum paid up requirement and reserve requirement specified in section 11, next comes not authorized to conduct. That means there is no license, there is a lack of license or cancellation of license. Then in that case, the RBI may apply for what? Winding up. Next, if the bank is prohibited, so from the central government or by the RBI due to any actions, it RBI has ordered or central government has ordered that you cannot accept fresh deposits in that case. Next, if the bank fails to, whatever the requirements are there, Banking Regulation Act or else the directions which are issued by the RBI, if you fail to follow these, comply these, then it can order for what? It can apply for winding up. Next, RBI believes that the court sanctioned whatever the bank in a stress situation, bank is in some insolvency situation, a compromise or arrangement is ordered, but that compromise or arrangement is not being successfully implemented, then winding up provision will be applied. And if RBI determines based on the bank's returns, based on the bank's values of assets and liabilities in the capital, it is in the position not able to pay off the debts, and it may affect the interest of the depositors. In this case also, it can apply for winding up. So in all these cases, RBI can apply for winding up. Are we clear? So RBI will apply and the liquidator will liquidate the particular banking company. Are we clear with this? So once again, we'll revise it quickly by using the highlighter over here. So first is nothing but minimum paid up capital and reserve requirements are not met, lack of license, and the next, sanctioned by the court that it should not, sanctioned by the central government or RBI, it should not accept fresh deposits, and fails to comply with the directions of the RBI and the requirements of the Banking Regulation Act 1949. And the next one, RBI believes that the court sanctioned compromise cannot be implemented successfully. And the next, based on the bank's return, it cannot pay debts harmful to the interest of the depositors. All these are situations where RBI may apply for what? Winding up of the banking company. And voluntarily also, banks can wind up the company, but we need a letter confirming from the RBI that is able to pay off all the debts. That means all deposits are being fulfilled. Then only we will allow you to wind up the banking company. A banking company cannot voluntarily wind up unless it receives a certification from the RBI confirming that it's capable of paying all its debts in full. Amalgamation of banking company. First itself, we have seen that a bank can acquire shares or controlling interest of another entity if it is also involved in the banking business. So in that case, it may result in the amalgamation of two banking companies. Is it allowed? Answer is yes. But amalgamation should be approved by at least two-thirds of the majority of the total voting rights of the shareholders in the general meeting. Two-thirds of the majority should be approving what? The particular scheme of amalgamation. So that approval of shareholders will be communicated to the RBI. RBI will check the scheme of amalgamation and it will pass an approval, and then it will be resulting in the winding up of the first bank which is being merged. That will be wound up and the new business will be amalgamated. Are we clear? So that's all related to the content. The scheme of amalgamation is to be approved by two-third majority. Important from an MCQ point of view. This line, two-third of the voting rights. The unwilling shareholders, if they are not willing to accept the amalgamation, then they will get the amount of value of their shares, and the RBI has to sanction the scheme of amalgamation after the shareholders approval is there. Whatever the assets and liabilities are there, the acquiring bank will be able to get that amount, get the transferred, and the RBI issues order for the dissolution of the first bank, whatever is there, which is whose assets are being transferred, that will be dissolved. And during the preparation of the scheme, if let's say due to amalgamation issues, if you want, RBI can order moratorium. That means temporarily it can stop the business for some time. Are we clear? But without moratorium also you can execute amalgamation. So as per the amendment of October 2020, RBI may initiate a scheme for reconstruction or amalgamation without imposing moratorium. The temporary suspension of activities is not necessary. Clear? So during preparation of scheme of merge or amalgamation, RBI may suspend business with the approval of central government. What do you mean by suspend? Temporary moratorium, stopping it. That's all. So these are the provisions which are very important from an examination point of view for banking regulation. So if I have to quickly recall, I know it's a too much content, and it's high level of wordings and terminologies. So you don't need to worry about that. Starting, make sure you learn about the dividends, loans, licensing of the banks, and SLR, CRR, and amalgamation, and then winding up. These are the important concepts from an examination point of view. So, this is all related to the Banking Regulation Act 1949. Are we clear? So, simultaneously, after this concept is done, go through the expected questions PDF, that is important questions PDF related to the question and answers. Read them, you will understand. Are we clear? And simultaneously finish off the MCQs also. You are good to go. That's all.